think that recession risks, I'm not going to give you a number because I think it's meaningless, but it is my base case scenario. I do not, and I would love to ask you, I would love to ask any of your viewers, they can all email me, you tell me where you see the vitality in the U.S. economy at this point. There is no fiscal stimulus coming. There is no tax cuts coming. If you read what's happening in Congress right now and the 30 Freedom Caucus members who are adamant about any increase in the deficit, these tax cuts aren't coming, but what is coming is spending restraint. As Donald Trump would say, spending restraint of the likes we haven't seen before. That is actually here, and it's going to continue. The rest of the world economy is flat on its back. So there's no multiplier impact from the export sector. Housing is being massively constrained by elevated mortgage rates and the fact that home prices are still well above, you can call quotes their intrinsic value. Affordability is a two standard deviation event. No first-time buyer can really afford to buy a home. It's why housing is in the doldrums. And the consumer just went on a spree to buy stuff to get ahead of the tariffs. So what do you do for an encore? You're not going to buy all that toilet paper and all that clothing and all that building materials. So the economy is going to be extremely weak. It's not going to be strong enough to justify the earnings embedded in the stock market. The Fed will scramble to cut interest rates just like it did in 2019. The Fed right now, look, Jay Powell tells us in December, here's monetary policy for the here and now. And he compares it, this is the Q&A session after the meeting, he says, what does a central banker do in this period of high and rising uncertainty? It's akin to being in a dark room with furniture. So what do? You stand still. So no surprise out of the Fed. They're just standing still until they get some degree of policy clarity and they see what inflation does, not in the month of April, but probably for the next several months. And whether this is a temporary shock, of course, they got transitory wrong. They're not going to make that same mistake twice, especially because Jay Powell's tenure as head of the Fed ends in May of next year. So he's not going to go out as the next Arthur Burns. So they'll be slow to cut rates. But if you remember, under similar but not same conditions in 2019, because the situation is much more fluid today than it was back then, but the Fed went into 2019 in their dot plot saying, we're going to hike rates twice in 2019. That's what they're telling the market. And of course, if you go to the FOMC policy minutes and you go to the transcripts, you get a real flavor for all the concern about tariffs and trade and inflation. They're going to raise rates twice. What do they end up doing in the second half of the year before COVID? They cut rates 3 times. The bond market was a great place to be, but you had to be patient. And I think we're going to replay something very similar this time around. The reason why the number was so surprising was you had a 20% annualized increase in business capital spending, which did not line up with the monthly indicators at all. That added a full percentage point to GDP growth. That came out of nowhere. The consumer spending numbers, as good as they were below expected. Housing remained in the doldrums. Commercial construction, there's nothing going on there. And the government sector, which has been a huge source of support for the economy, is now moving the other direction. So yeah, you had a lot of trade distortion, a lot of tariff distortion in that number. But when you're looking at the components that made sense, if you're taking a look at the incoming monthly data, it was consistent with a contractionary economy. You know, you talked about the soft data and the hard data. Well, here's the reality. Everybody bows to the holy grail of the hard data, but the hard data gets revised. I mean, look at the revisions. You just got to non-farm payrolls. They were huge. Non-farm payroll seems to get revised 3/4 of the time downward every month. Hard data gets revised because the government tries to release the hard data in a timely fashion, which means they give us incomplete information. It's not that they're stupid. It's not that they're slow. It's just that the data we get, whether it's retail sales, or whether it's employment, whether it's durable goods shipments and orders. This is all government data from the Commerce Department, and these numbers get revised substantially. When did they date the recession? When did the NBER come out and tell us about the recession? In 07, 08, they told us in December of 2008 that we had a recession. And the recession started in December of 07, 12 months earlier. Why? We were in a recession 12 months, and the NBER tells us in December, the recession was almost over at that point. It ended in June of 09. Most people didn't even know in the summer until basically Lehman collapsed that we had a recession. And of course, it sounds like a bit of a joke, but it's not a joke. They're just waiting for all the revisions. They know the data are going to get revised. People were actually shocked that it started in December of 07, because even Bear Stearns didn't collapse for 3 months after the recession started. You see, people think that the financial calamities caused the recession. No, actually the recession, part of the business cycle, ends up impairing cash flows and the quality of balance sheets, and that's what triggers the financial instability. The causation runs the other way. So the reality is that the soft data, which is the survey data you're talking about, that doesn't get revised. That doesn't come from the government, and it's all behavioral. You showed me before about the University of Michigan index. It shows you 12-month expectations. When you go to the non-farm payrolls, the non-farm payrolls is a robot, okay? It spits out a number, and then millions of traders trade around the number, but it tells you nothing about the shifts in the pattern of behavior. But you flash the University of Michigan survey, which shows you that at the margin, households are becoming very nervous about their job. 1 in 7 Americans now are fearing a job loss. You got the share. You know that half of the American public don't believe they're going to get any wage increase at all in the coming year. And the median increase is the grand total of 0.4%. So I actually find it very interesting that the Fed is so consumed with inflation fear from the tariffs, and yet Jay Powell says each and every meeting there's no inflation coming out of the labor market. Well, you can't have it both ways, because if there is no inflation coming out of the labor market, there's no inflation coming out of anywhere. And that's where people got it wrong, including me, by the way, in 2022 and 2023, that we did get inflation out of the labor market, right? We did have people job hopping. There was a tremendous demand-supply mismatch in the labor market coming out of COVID, all the stimulus checks. The fact on top of the stimulus checks, people were getting paid unemployment insurance that paid them more not to work than to work. So companies had to increase their wages dramatically. So we had a wage price spiral for 18 months in 2022, 2023. This time around, there ain't going to be no spiral. The inflation is going to hit the wall in the labor market. And you see, that's the beauty of the so-called soft data. And the reality of the situation is this. In terms of causation, the soft data leads the hard data. So we're all saying we're going to wait, and the Fed's saying we're going to wait for the soft data to hit the hard data. Well, I'm going to tell you something. By the time it hits the hard data, it's too late. The recession has started, and the Fed will be scrambling hard to cut rates. And the Treasury market will be rallying significantly. And that's going to be the story, in my opinion, in the second half of the year, which is starting in about 6 weeks' time. A month ago, the Bank of Montreal Global Fund Manager Survey showed that world portfolio managers had a 38% net underweight exposure to the US stock market. And now they have to participate or they'll lose their clients. So you're seeing that gap close. It's really a classic short squeeze that's taking place, but also real-time investors have to get to their bogeys or their benchmarks. So there's a very strong fund flow impact that's going on right now. It's fun to trade, but I don't think it's going to be sustainable. You have a 4.8% earnings yield in the S&P 500. You got 4.5% on the 10-year note. You got 4.4% in cash, in T-bills. So I'd say if you're chasing the stock market right now, do so for a trade, but from an investment standpoint, it is not what I would refer to as prudent risk management. So I would say take down your cyclicality of your overall asset mix, take down the beta, de-risk. I would say if you didn't get out the first time, from February to April, and you were there with your white knuckles, oh my God, the market selling was 20%. Now we reverse that. This is a gift from the gods to actually cleanse your portfolio and de-risk it. You're getting a second opportunity. But you see, what most people are going to do, because greed is such a powerful emotion. I've been doing this 40 years. Gordon Gekko, greed is good. And instead of doing the right thing, which is to use this as an opportunity to de-risk, I bet that most people on this call are going to do the exact opposite, because chasing rallies tend to be a lot of fun, I guess. Not prudent risk management. So I would have cash, I would have treasuries, I would have gold, I would have the gold miners. Within the equity market, there's parts of the equity market I like a lot. I like what I call bonds and drag in the stock market. Stable industries that have solid dividend payout ratios and a decent yield. Do I like utilities? I do. Do I like the financials? Some of them I actually do. Do I like telecom providers? Some of them I do. What I would do in my equity portfolio is make sure that it's low beta so that you will capture any upside, but you won't capture much of the downside if things roll over. So I'd focus on the beta of the portfolio, and I would focus on the running yield of the equity portfolio. On top of that, I would say that go to the areas of the world that have some visibility. And Europe actually has fiscal visibility. I think that their economy, believe it or not, is going to outperform the US economy. I think it's going to be a better currency. And I like especially the aerospace defense industry because that's where the money's going to be flowing. And I would say my favorite currency, it might be tied right now, but it's the euro and the yen. And I think if you have euro and the yen, you have aerospace defense, which obviously for a whole host of reasons has earnings visibility for now and the future, bonds, cash, and the more defensive bond proxies in the stock market, I think you'll be good to go. Well, one thing I missed, by the way, was the gold and the mining stocks, but you're 100% right. I could tell you in my years at Gluskin Chef, it was actually, I learned so much, 12 years on the buy side. And I heard that from many clients, just the anger and anxiety and angst. You can see their blood boiling when even if they were up 20%, if they were out washing their car and their neighbor passed by and said he was up 30%, ooh, the anger and the angst was incredible. So I've had people tell me that too. People have told me I would rather lose money in real time than underperform my neighbor. And I'm there thinking, okay, that's not my philosophy, but thanks for sharing that with me. I'm just telling you, if you ever interview any NHL coach, any NBA coach, any baseball coach, they'll always say, I hate losing. And I'm going to tell you something, I hate losing money. And I guess this is one of the beauties about being a quotes perma-bear, which is actually not true. I'm just conservative, cautious. And my philosophy over time, and maybe this is just for a certain demographic, is I believe in the preservation of capital and the preservation of cash flows at all times. Full stop. I'm bullish on bonds and I'm bullish on gold and I'm bullish on bond proxies. I'm just not bullish on anything that touches the cyclical part of the economy. Sorry about that. I know that might offend some people, but I'll tell you, I think that you want to dial down the risk right now. And it's a perfect time because this is a massive market overreaction to what happened last weekend in Geneva. I'm not going to say that it wasn't good. It was just basically less bad. But the markets are pricing in something that I think is not so nirvana-ish because we're going to be entering new chapters of this trade conflict. It is foolhardy to believe that what happened over the weekend has meant the termination of this trade war. I think that's a serious mistake people are probably making right now.